Macklem and Senior Deputy Governor Carolyn Rogers conclude their press conference on a day when the Bank of Canada has, as expected, cut its benchmark lending rate by a further 25 basis points, bringing it down to 4.5%. It was a statement clearly more dovish than earlier statements from the Bank of Canada, clearly more confident that inflation is sustainably on its way down, and clearly more concerned with economic growth in Canada now. There were several references by Tiff Macklem in particular to the tune of we need to get economic growth moving up. Here is a comparison of the June the 5th statement when the bank also cut its rate. The bank said with continued evidence that underlying inflation is easing, and it went on to say it had taken the decision to cut the rate. It also said recent data has increased our confidence that inflation will continue to move toward the 2% target. Today, the bank is much more confident, and twice in the final two paragraphs of its statement today mentions that 2% target in a way that makes it clear the bank is confident that is where Canadian inflation is headed. The bank's preferred measures of core inflation are expected to slow to about 2%. There's that target number in the second half of 2024, with broad price pressures continuing to ease and inflation expected to move closer to 2%. The bank prefaces another sentence with. So the bank seems much more confident that it is winning the battle against inflation, now seemingly more concerned about economic growth in this country. Let's bring in a couple of experts to continue the conversation. Etienne Bordeleau-Labrecque is Vice President at Ninepoint Partners. And Sal Guatieri is a familiar face. He's Senior Economist at BMO Capital Markets. Gentlemen, thank you very much for joining us. Etienne, let's start with you. What is your take on the bank statement, and particularly this concern about economic growth?
Yeah, so I think we've seen downside risks emerge in the Canadian economy for several months now. We're seeing consumption very weak. Retail sales are going down, not up. You're seeing delinquency rates in mortgages, credit cards, all sorts of consumer lending products going up as well. So economy is weak, the consumer is weak, business investment is uncertain, particularly given what we're seeing south of the border with the election, the prospects of more trade wars with potential President Trump. And finally, household residential investment has been weak with affordability where it is. I don't think a couple rate cuts is going to change things materially. So overall, I think the Canadian economy is weak and is not going to get any better. I think the Bank of Canada's expectation for the second half is probably a little bit too optimistic. So I would expect more rate cuts to come as the fall rolls in. Including in September? Probably, yeah.
Okay. Sal, same question to you. We didn't hear the phrase soft landing during that press conference, but do you think the bank can engineer one?
That is our overall view, that the bank will successfully keep the economy at least on a growth track, a modest one this year, picking up next year. But fully agree with some of the comments you made earlier and the guests' comments that, yes, the Bank of Canada is growing increasingly confident that it will get inflation down to the target. But the new wrinkle here, as you mentioned, is they're also growing increasingly concerned about possibly undershooting that target, simply because the economy has been quite weak. And Governor mentioned that we will need to see economic growth pick up to simply prevent the unemployment rate from rising. If the economy remains weak or if population growth remains overly strong, that jobless rate will continue to go up. And that would be a clear indication that wage growth will downshift and inflation will just keep falling. So the Bank of Canada does need to spur some economic growth over the next year, or it will be at risk of undershooting its target. So it clearly is planning a further series of interest rate reductions, though, as the governor mentioned, it will be on a meeting-by-meeting basis. So it will come down to the data. But the bank has not just keeping an eye on the inflation ball now, it's also keeping a close eye on the labor market and the unemployment rate.
Etienne, the bank identifies shelter costs as a sticky point in inflation. It's one of the factors keeping inflation up rather than down, and it identifies it as being a headwind to economic growth. And it's not something that moves quickly. The cost of housing.
No, and that's not something they can really do much about. And we're seeing it in major markets. We saw some real estate data released over the last few weeks, and we see this sales to new listing ratios are coming into better balance. So I think the seeds are there for housing prices to keep coming down slowly, particularly in markets where they went up as fast as they went during 2021, 2022. So I think it's happening. It just takes time.
Sal, how sticky do you expect wage growth to be? We do have many more job vacancies and a much higher rate of unemployment than we did just a short time ago.
Yeah, I mean, wages historically are a slow-moving train. They tend to be very sticky, even stickier than inflation. So it will take a while, but clearly the direction will be downwards. If the unemployment rate continues to rise, if job vacancies continue to fall, the labor market is just is loosening by the month, and we're creating more and more slack in the economy, partly because of the weak economy, partly because of strong population labor force growth. So that's a pure recipe for weaker wage growth and eventually much lower inflation. So that's something the Bank of Canada will need to take into consideration in future policy deliberations.
I'm going to check in on the Canadian dollar. We should bring the Canadian dollar up and show our viewers as well, because the statement from the Bank of Canada clearly dovish. We are seeing some modest pressure on the Canadian dollars, down very, very slightly. Etienne, what's your take on the Canadian dollar? The bank never explicitly acknowledges a concern about affecting the dollar one way or another, but clearly what it's done today, and you would think the language that it's used today, is Canadian dollar negative.
Yeah, so for sure, but I don't think the bank really needs to bother as much as people say about the Canadian dollar weakness. It seems more likely than not than the Fed's going to go in September. The U.S. economy, just like our economy, is finally slowing down as well. So maybe we expect a few more rate cuts in the U.S., more rate cuts in Canada. So overall, maybe the Canadian dollar is depreciated close to enough. And there's been some great work by Sal's team and other economics teams on the street looking at the inflation impacts of a weaker dollar, and it's not as big as people think.
Tell us about that, Sal. What do you think about a weaker Canadian dollar and the prospects of importing inflation as goods, particularly from the United States, become more expensive?
Well, we are seeing the Canadian dollar weaken. In fact, it did weaken a bit further after today's announcement in anticipation of further rate reductions. But the important thing is it's weakening very modestly and generally against a very strong U.S. dollar, which is basically strong against all currencies. So I don't think it's much of a consideration for the Bank of Canada. Probably is not putting much upward pressure on inflation. In fact, core goods prices in Canada are still either flat or even down from a year ago. So there's really not a whole lot of import pressure or goods pressure in this economy. Most of the inflation pressure is still on the services side, in the rental side, for example. So I don't believe the Canadian dollar is much of a factor for the Bank of Canada. If it does weaken much further, it would be a consideration. But the Federal Reserve is probably planning to cut rates later this year as well. So I think that will limit how much further the Bank of Canada, the Canadian dollar falls.
Etienne, you've noted that consumer spending is weak, consumer delinquencies on the rise. How much of an assist are lower rates to turning both those trends around?
Well, for credit cards, given the way the Canadian market works, unlike the U.S., it's not floating. So that doesn't really change anything. For mortgages, a lot of people are renewed into fixed rate mortgages. A lot of mortgages that have locked in really, really low rates are still renewing at much higher rates despite the rate cuts. And if you think about 5-year mortgage rates, they already incorporate the market's expectation of forward rate cuts by the Bank of Canada. So unless they start cutting a lot more aggressively, I don't see a lot of changes to the mortgage rate environment people are going to face. So that will remain a headwind for a long time.
Sal, should the bank be concerned about spurring activity in the housing market with lower rates?
I think that was the concern several months ago before it started cutting rates, that the housing market would just take off, in particular prices, but we're certainly not seeing that. There are still some hot pockets across the country where a lot of people are moving to still affordable regions, the prairie provinces, Atlantic Canada, but certainly in Ontario and BC, the housing market is still weak enough. We also are seeing some downward pressure in the rental markets as well. So I really don't think the housing market is much of a concern for the Bank of Canada. If later we start to see prices move up more aggressively in response to lower interest rates, that might be a factor in tempering the pace of monetary easing. But for now, I don't believe it's a concern of the Bank of Canada.
Go ahead, Etienne.
But you need to put this all into context. If wage growth does decelerate because the labor market is softer, if there's more unemployment, despite lower interest rates, it's hard to see the housing market really bounce back. So we have to look at this all together.
Etienne, Tiff Macklem took an interesting question on the distinction, if you want to call it that, between aggregate gross domestic product growth and per capita gross domestic product growth. And we've actually seen, of course, for several quarters now, gross domestic product growth on a per capita basis come down. His answer, perhaps understandably, was we have to look at both. But what, as an economist, what do you look at, and how should Canadians think about gross domestic product growth on a per capita basis, in which is declining, or on an aggregate basis?
Well, if you want to look at it from a purely economic perspective, your welfare as a Canadian is your GDP per capita. Mm-hmm. It's not an aggregate. If we grow GDP but we collectively get poorer per capita, we're not better off. So what we've seen, and I don't have the data in front of me, but GDP per capita is much lower than it was even 4 or 5 years ago. So it's declined materially. And that's because of very fast population growth, and a lot of the data that you see in some of the boxes in the NPR kind of corroborates the story that very fast pace of newcomers, they consume a lot more than they produce, so you end up with an economy that ends up not generating as much GDP growth per capita as you would hope. And that's why collectively we're poorer now than we were 4 or 5 years ago.
Sal, we'll finish with you. A related question. The Monetary Policy Report did indeed devote several pages to the question of per capita gross domestic product growth and the effects of immigration on things like the housing market and the economy. What was the Bank of Canada trying to tackle when it devoted that much attention to immigration and the economy?
Well, population growth will be a key factor in your outlook for the economy. If the population is growing, as it has been, at a 3% plus rate, basically that should set the floor for economic growth, especially for demand and to some extent supply as well. Now, we've been undershooting that for a couple of years now, so real GDP per capita has been shrinking. So technically, on that basis, we have been in a sort of living standards recession. So that's telling the Bank of Canada that overall demand in the economy is still fundamentally weak because households are paying more for mortgage payments, for higher borrowing costs. Businesses have been pulling back as well. So it's really just telling the Bank of Canada that the economy is underperforming its potential. In this case, determined by population growth. Going forward, the bank does expect population growth to slow over the next couple of years as the government curbs temporary immigration. But overall, it's still going to be a fairly soft environment in per capita terms. And again, that does suggest the need to push interest rates down further.